Edward Parsons. I'm a certified public accountant with Planner CPA.com, and I'm here to answer some questions that have been submitted through our website. If you're an American citizen or a green card holder, you're required to report your worldwide income on a federal income tax return each year, as long as you meet certain minimum thresholds that depend on your filing status. If you're self-employed, however, and your net income is $400 a year, you already have a filing requirement. For the other filing status, you can think about an average of $4,000 to $8,000 a year gives you a filing requirement. At that point, it's irrelevant whether you're living abroad or you're living in the United States. What matters is your gross income for the year. Now, that doesn't mean you have to pay taxes. It just means you have to file your tax return. If you're living abroad, you're entitled to certain special exclusions and deductions that will allow you to probably not pay any tax to the United States. The two largest advantages that American citizens living abroad have as it relates to their tax returns, which are the ones that are going to allow you to probably not pay any taxes to the federal government, are the foreign earned income exclusion and the foreign tax credit. The foreign earned income exclusion allows you to exclude from federal taxes the first $92,900. This amount changes each year, so please check our website for the amounts. This has to be earned income. Certain items like Social Security, pension, interest, dividends, capital gains, that's not considered earned income. If you're working in exchange for the amount that you're receiving, that will be considered earned income. The simplest example is salaries, or if you're self-employed, your net profit from your business. It can get a little complicated for items such as royalties if you're a writer or a performance artist, but if it's something you're working for, then chances are it falls under the category of earned income. Please see this link for a definition of what is and what is not earned income. The second advantage that I was discussing is the foreign tax credit, which allows you to reduce your U.S. tax liability dollar for any taxes paid to a foreign jurisdiction. Again, it has to meet certain criteria, but as it relates to this conversation here, if you're paying taxes to a foreign jurisdiction, you're going to end up paying the higher tax rate between the U.S. and your foreign country. So if in the foreign country you pay 25% effective tax rate, and in the U.S. you would have paid 20% effective tax rate, then you're not going to have any taxes due to the U.S., and you actually have a 5% carryover to be used in the following year. The opposite is if the foreign jurisdiction's tax rate is 15% and the U.S. would have been 20%, then you're going to end up paying the difference of the 5% to the U.S. Again, there's complications, or not complications, there's calculations. We have to take into account the foreign earned income exclusion with the foreign tax credit and how we're going to combine those two. You can also select to itemize the foreign taxes paid, which is another route, probably not mathematically the one that will work out, but the bottom line is that there are options. Just because you have to file your U.S. tax returns doesn't mean you have to pay anything. Hi, my name is Edward Parsons. I'm a certified public accountant, and I am an expat.